Welcome back to the Crypto Strategist, your trusted source for the biggest XRP developments, crypto regulation updates, and institutional adoption news shaping the future of digital assets. Today we are diving into a major story that could end up being remembered as one of the most important moments in XRP history. The latest developments surrounding the Clarity Act are gaining serious attention in Washington, and some analysts believe this legislation could create the conditions for the largest institutional expansion the crypto industry has ever seen. If you're holding XRP or simply following the evolution of digital assets, what happened this week deserves your full attention. Before we begin, remember that nothing discussed in this video is financial advice. Always do your own research before making investment decisions. Now let's break down exactly why so many market observers are closely watching this legislation and why some believe it could become the catalyst that changes everything. To understand why the Clarity Act matters so much, we first need to look back at a historical event that transformed global finance. In the year 2000, the United States passed the Commodity Futures Modernization Act. At the time, very few people paid attention. It wasn't a headline-grabbing moment for most Americans, and certainly not something that dominated mainstream conversations. However, what that legislation accomplished was incredibly significant. It provided clear, legal definitions and regulatory certainty for derivatives markets that had previously operated in a gray area. Once institutions understood the rules, capital poured into the sector. Over the following decade, the derivatives market expanded from roughly $100 trillion to more than $600 trillion. The lesson was simple. When uncertainty disappears and clear rules emerge, institutional money tends to follow. That pattern is exactly why many investors are paying close attention to what is happening with digital asset legislation today. Many supporters of the Clarity Act argue that crypto is currently sitting at a similar crossroads. The industry has spent years dealing with conflicting interpretations, regulatory uncertainty, and a lack of clear definitions. Companies, banks, and institutions have repeatedly said they want to participate in the digital asset economy, but they need legal certainty before deploying significant capital. The Clarity Act is designed to establish those rules. Instead of operating in a regulatory gray zone, market participants would finally have a framework that explains how digital assets should be classified and regulated. For institutions managing billions or even trillions of dollars, that distinction matters enormously. Capital generally avoids uncertainty and seeks environments where rules are clearly defined. That is why many believe the Clarity Act could become one of the most consequential pieces of crypto legislation ever introduced in the United States. What makes this even more interesting is the sheer size of the opportunity being discussed. Analysts continue to debate exactly how large the digital asset market could become over the next decade, but projections regularly reach into the tens of trillions of dollars. Beyond cryptocurrencies themselves, there is growing discussion around tokenized stocks, tokenized bonds, tokenized real estate, tokenized debt instruments, and countless other traditional financial products migrating onto blockchain infrastructure. When you begin examining the total value of global financial assets, the numbers become almost impossible to comprehend. The conversation is no longer simply about cryptocurrency speculation. It is increasingly about the modernization of financial infrastructure. If blockchain technology becomes a foundational layer of global finance, the assets facilitating that transition could occupy a very important position within the system. One of the biggest developments this week came from Treasury Secretary Scott Bessent. During a public appearance, he spoke about the administration's approach to digital assets and highlighted the importance of bringing innovation under clear American regulatory oversight. More importantly, he stated that he looks forward to seeing the Clarity Act passed this summer. That statement immediately attracted attention because it wasn't coming from a market commentator or industry influencer. It came directly from one of the highest-ranking economic officials in the United States government. When someone in that position publicly expresses confidence about legislation moving forward, investors tend to pay attention. While no bill is guaranteed to pass, comments like these provide valuable insight into how key decision-makers currently view the legislative process. At the same time, lawmakers continue discussing timelines for potential passage. Several members of Congress have suggested that momentum behind digital asset legislation remains strong. Bipartisan support has been cited repeatedly as a major factor helping the bill advance through various stages of review. While there are still debates surrounding certain provisions, the overall direction appears significantly more constructive than what the crypto industry experienced during previous years. Many observers now believe the most realistic timeline would involve movement before Congress enters its August recess. That does not guarantee immediate implementation, but it does create a framework that market participants can begin preparing for. Every week that passes without major setbacks strengthens the perception that meaningful regulatory clarity may finally be approaching. One of the most overlooked developments this week involved a letter sent by several pro-crypto senators to banking regulators. While most headlines focused on legislative progress, this letter addressed something equally important: bank capital requirements. For years, one of the largest barriers preventing banks from holding digital assets has been the extremely restrictive capital treatment assigned to those assets. Under existing frameworks, certain cryptocurrencies can receive risk weightings so severe that holding them becomes economically impractical for financial institutions. In many cases, the math simply doesn't work. Even if a bank wanted exposure to digital assets, regulatory requirements could make participation prohibitively expensive. The senators specifically challenged aspects of the current framework and argued for a more technology-neutral approach. Their position is that digital assets should not automatically receive punitive treatment solely because they utilize blockchain technology. Instead, regulators should evaluate assets based on their actual function and risk characteristics. This distinction is incredibly important for XRP. If regulators eventually determine that XRP serves a functional role within payment infrastructure and settlement systems, it could potentially receive treatment different from purely speculative assets. That would significantly alter how institutions evaluate XRP within their operational and liquidity strategies. For XRP holders, this may actually be one of the most important parts of the entire story. Many investors focus exclusively on price action, market sentiment, or social media narratives. However, institutional adoption is often driven by regulatory and economic considerations rather than excitement. Banks do not make decisions based on internet trends. They evaluate costs, compliance obligations, capital requirements, and operational efficiency. If regulations evolve in a way that allows banks to hold XRP more efficiently, the potential implications could be substantial. Conversely, if restrictive treatment remains in place, institutions may continue utilizing related infrastructure while minimizing direct exposure to the asset itself. This distinction creates two very different adoption pathways. In one scenario, banks leverage payment technologies, settlement networks, and blockchain infrastructure without maintaining meaningful XRP positions on their balance sheets. In the other scenario, institutions actively hold XRP as part of their operational liquidity strategy because regulations make such participation economically feasible. The difference between those two outcomes is significant. That is why the recent regulatory discussions may deserve just as much attention as the legislative process itself. Legislation can open the door, but regulatory implementation ultimately determines how institutions walk through it. Another important theme emerging from these discussions is the difference between digital assets serving as stores of value and digital assets serving as infrastructure. Bitcoin often dominates headlines because of its size, recognition, and role as a digital store of value. However, many policymakers, developers, and financial institutions are simultaneously exploring blockchain networks designed for payments, settlement, tokenization, and financial interoperability. XRP frequently enters these conversations because its core purpose has always centered around efficient value transfer. Understanding that distinction helps explain why discussions surrounding XRP often focus less on speculation and more on utility within financial systems. The global implications are also worth considering. Financial regulators around the world closely monitor developments in the United States. When the world's largest capital markets establish clear rules for emerging technologies, other jurisdictions often take notice. Many countries have been developing their own digital asset frameworks, but there is widespread recognition that American regulatory decisions carry enormous influence. If comprehensive digital asset legislation succeeds in the United States, it could accelerate similar efforts internationally. This potential regulatory domino effect is one reason many analysts believe the Clarity Act represents more than just a domestic policy discussion. Of course, challenges remain. There are still disagreements regarding stablecoin provisions, decentralized finance protections, compliance standards, and various implementation details. Major financial legislation rarely moves through Congress without negotiation and compromise. In fact, the most impactful legislation often experiences the most intense debates. The existence of unresolved issues does not necessarily indicate failure. Instead, it reflects the reality of crafting policy that affects an emerging industry with potentially global implications. Market participants should expect continued negotiations as lawmakers work through these complexities. Interestingly, even some institutions that have historically approached crypto with skepticism are acknowledging that the legislative window remains open. That shift in tone is notable because discussions increasingly focus on the structure of regulation rather than whether regulation should exist at all. In many ways, the conversation has evolved from questioning whether digital assets belong within the financial system to determining how they should be integrated. That represents a meaningful change from previous years when uncertainty dominated much of the public debate. Over the next several weeks, there are several developments investors should monitor closely. First, watch for the release of updated legislative language and any revisions that emerge during negotiations. Second, pay attention to reactions from banking groups and financial institutions, as their responses often provide clues regarding implementation prospects. Third, monitor regulatory discussions surrounding capital treatment and risk weighting. These conversations may ultimately prove just as important as the legislation itself when it comes to institutional participation. Together, these indicators can provide a much clearer picture of where adoption is heading. When we step back and examine the bigger picture, the parallels become difficult to ignore. The Commodity Futures Modernization Act created a framework that allowed institutions to enter a previously uncertain market at unprecedented scale. Today, supporters of the Clarity Act believe something similar could occur within digital assets. No one can guarantee outcomes, and history never repeats itself perfectly. However, the pattern of capital-seeking regulatory certainty has appeared repeatedly throughout financial history. Whether crypto ultimately reaches the scale some analysts predict remains to be seen, but the importance of clear rules is undeniable. The biggest takeaway from this week's developments is that legislative progress and regulatory reform appear increasingly connected. Treasury officials are expressing optimism. Senators are addressing bank capital treatment. Bipartisan support continues to be discussed. Financial institutions are paying attention. And perhaps most importantly, the conversation is shifting from uncertainty toward implementation. For XRP, that shift could be particularly meaningful because the asset's long-term thesis has always been tied to utility, payments, settlement, and institutional participation. If regulatory barriers begin falling, many believe the environment for adoption could change dramatically. As always, I want to hear your thoughts. Which development from this week do you believe deserves the most attention? Is it Scott Bessent's comments about summer passage, the growing momentum behind the Clarity Act, or the regulatory discussions that could influence whether banks eventually hold XRP directly? Let me know in the comments below. If you found this breakdown valuable, make sure to like